I've written a book on the bottom of bear markets. If I ever try to write one about the top, shoot me. I don't think you can do it.
No.
Because there's so much psychology in there. So Pepper's Law is something that it's named after Gordon Pepper, a friend of mine who was did sort of what I do a long time ago, from the 60s into the 70s into the 80s. And on his feet one day, because he was teaching in my class, someone said to him, "How do you call the top of a bull market?" Which, I think you could write 50 books on that and not know the answer to that. And just off the top of his head, he said, "Well, you work out how long you think this can go on, then you double it and take off a month."
The top of the bull market.
Yeah. If you see a real raging bull market, however long you think it's going to go on twice as long, and then you take off a month just to be on the safe side.
And then you might still be wrong.
And you might still be wrong. So at least in a bear market, you kind of know when things are cheap. You don't know that they're going to get cheaper, but at least you know they're cheap.
You know they're worth buying.
You know they're worth buying, and over a long term, they're going to be absolutely fine. So there's something more tangible there. And then in my book, I look at why real big bear markets trigger tangible changes in the structure of monetary policy, which we saw with the introduction of QE. So I think there's much more chance of getting the bottom of a bear market than top of a bull market. Of course, there's psychology. There's the psychology of doom at the bottom of a bear market.
It's never coming back.
It's never coming back. It's all over. It's going to zero. Yeah. What do you think you're saying? But at least you know when you're getting some sort of value. But at the top, it's all psychology. It's very, very difficult. I'd love someone to write a book about top of bull markets. I'd love someone smarter than me. And I think it would have to be a psychologist to write that book.
Well, this is why we hang on to stories like when the shoe shine boy tells you to buy a stock. That's when you get out, because there is no, this is the marker. Because every time we say something's expensive, Palantir comes along and is 400 PE and is the highest valued stock ever on earnings.
I think one of the ways you can do this is you can look back with the benefit of hindsight and say, with the benefit of hindsight, why did we know the stock market topped in March 2000? And their answer is, even with the benefit of hindsight. There's one report on the cash burn in corporations, which often gets a lot of credit. I'm not sure how true that is. If you can't tell why something goes up and down, even when you're looking backwards, you've got a hope in hell of working out going forward. And I think most bull markets, you can say, I know why it couldn't go on, but I don't know why it stopped that month and not 6 months before or 1 year before.
I think the answer is simple, because when you're approaching the top of a bull market, people are buying things that they don't know what they are, they don't know why they're priced that way. So there's no rational argument towards the price.
But the thing is, it can go on for much longer than you think.
Because they don't know what they're buying or what the price is. Whereas people like yourself would be like, why are people buying it at this price? That's not even in their heads. It's just, my mom told me it's going up, so I'm buying it.
In that bull market, the dot-com bull market, there were companies, let's say it was a pet food company, it would just put .com after its name and it would double.
Yeah.
So you saw things like that and you said, this isn't going to end well. But it went on for another year. That wasn't enough. I mean, it was enough if you're a long-term investor to say, get the hell out, don't touch this stuff. But if you're only trying to call the next 12 months, that kind of stupidity wasn't enough. The quote you gave was from Keynes, the market can remain irrational longer than you can remain insolvent. And he should know, because he was quite often teetering on the verge of insolvency. Because he worked on leverage. He borrowed money to have his, what he called, what did he call it? It was business cycle. He didn't call it business cycle, credit cycles. And he was a genius, but even he couldn't call the top of bull markets.
Isaac Newton lost most of his money investing in, what was the shipping company? It was a big bubble. South Sea bubble. South Sea bubble.
Yeah, so he actually said, I think I can discern the movement of the heavenly bodies, but I cannot discern the movement of men.
Yeah, probably the smartest guy, or one of, and he couldn't do it.
We should just have a list, actually, of all the really, really smart people who've lost money in the stock market.
Yeah, I must be really dumb, because I'm doing all right.
There's a lot to be said for it. As I said at the beginning, character counts. And, being so arrogant that you think you really know may be the most dangerous thing in the financial markets.
That was a clip from our full-length conversation with Russell Napier, who's a financial history expert. If you want to watch the full interview, you can check it out right here.